Ladies and gentlemen, welcome to this special interview. Today we have a first-time guest to the show, Chris Vermeulen from Technical Traders Ltd, located at thetechnicaltraders.com. Chris is a technical trader and he's a friend and a contributor to Silver Doctors. He offers a newsletter that you really need to subscribe to because it comes with a money-back guarantee or a performance guarantee, and we're going to ask Chris about that at the end of the video. But Chris also is a regular contributor to Silver Doctors, and we don't even have time to publish all of his free research, so you really need to be hitting up his website on a daily basis. Chris, I'd like to welcome you to Silver Doctors.
Hey, thanks for having me on, Paul.
Now, Chris, what a world we're living in 2020. This is not what anybody really would have predicted coming into this year. So
No.
as a technical trader, the question that I have for you is, how are you using the charts in light of what is going on in the world around us, Chris?
Right. Yeah. I'm a pure technical chartist, so I don't get sucked into the news and earnings and conspiracy theories. I mean, all that stuff goes out the window. And I learned that years ago, that if I got rid of the noise and I just focused on price, because the only way we make money is if price moves in our favor. So why try and predict news and events? So it's been a wild year, and I use a system that I called the band system, which is kind of something I just created. Really, it's the best asset now. And so I'm looking at all the different asset classes, different sectors, commodities, you name it, and I'm looking for the asset that has the best, the least amount of risk, the highest percent of probability that something's going to play out, and it's got the most upside potential. So I mean, on any given week, who knows what the best asset is going to be? I think very soon it's going to be precious metals, more so like the gold miners, the large caps, which we can touch on. But really, going into this year, come January, we saw the bond market starting to become the best asset. And we got long bonds, and it rallied 30%. And it really spiked as the market started to crash. And that was our big trade for the year. We were long equities. We got long bonds as well. We were long actually gold miners, and we profited from them all. And eventually our trailing stops protected us. So as price started to fall, we got out, closed profits. And so, it really comes down to money management, following what the most significant asset is. Where's the money going? What's the best asset now? And so that's the strategy that I follow. You want to be in the leaders, not the laggers.
Mm-hmm. And part of that is because, unless you're selling put options or call options, you want to be where, the underlying is moving, because the worst thing that something can happen is just sit there and not move. So you can also make money on the downside if I'm understanding that correctly as well. Mm-hmm. Now, could you focus a little bit more on price there? Because I know in your writings that come, you're talking about Fibonacci levels as well. So could you just give a really quick crash course on why you look at price more than anything else, and how you tie that into the mathematical formulas that you use to determine where the hot sectors are?
Sure. Yeah. Well, price is more or less the emotion. It's the commitment, the confidence that individuals and investors have in that asset or that company. And really, when it's rallying, it means people are happy, they're excited, they want to own it. When it's going nowhere, people are wondering what's going on. And when it's falling, people are scared, so they're selling it. And humans move in kind of wave-like patterns. The whole, you name it. Fibonacci is a very powerful formula. It's in everything in the world, in the universe, everything that's living and moving. And so I use Fibonacci for almost everything. I use it to find my profit targets, my protective stop levels, you name it, going forward. And so, human psychology even moves in those kind of fractal ways. And so it's really just gets implied right into the price of the market. And you can follow these wavelengths that are not only cycles, but they're Fibonacci targets of how long certain emotion or waves will actually last. So there's all kinds of different layers of technical analysis you can overlay on each other, but it always comes down to Fibonacci, I find, for everything. I mean, if something reversed, you can always find on the chart, usually you can say, oh, well, this is why that should have reversed, because previously on the chart, it was a significant point, and everything kind of matches up that it's one of those 618 retracement or extensions or 100% measured move. And those are the two that I always use for everything. Just, I don't know why, but they just work like a charm.
Yeah, and Chris, it drives me crazy because, I consider myself a fundamentalist first and foremost. So we'll start getting going on a run here, and especially with silver. And I'm like, all right, $20, here we come. We're coming up on $20. And then you'll send us over one of your recent articles and you'll be like, we're getting ready for a rotation in gold and silver. And I'm like, oh, goodness, here we go again. So if we can, dial it into the detail a little bit when talk about the stock market, because recently you've written that this, hold on a second, this might be a sucker's rally or a bear market rally in the stock market. So is that because we've hit a certain Fibonacci target, or could you talk a little bit about why we might be in a sucker's rally in the stock market right now?
Sure. Yeah, there's a lot of layers in there. I don't know, you can go on about it forever, but long story short is if you go back to 2000, we had the tech bubble, it popped, market corrected about 40% in the NASDAQ, and it bounced up a Fibonacci target, which was about a 40% rally, 46% actually, and then it rolled over and sold off. And that type of bubble that burst back then, to me, is actually very similar to what's happening right now. Back then, everyone got into the tech bubble, into the tech stocks. It went parabolic, just like stocks did last year. And then suddenly when earnings came out, they realized these companies had raised hundreds of millions, can't make a dime. They're money pits. And everybody realized it at the same time. So they hit the sell button, market crashed 40%. Same thing this year. Everyone piled into the stock market. The virus came. And then suddenly everyone realized that there's going to be no good quarterly earnings next quarter. And so every hedge fund, every fund is starting to sell, and everyone knows. So that's why we crashed almost 40%. And so it's a very similar setup. And now we're looking for this dead cat bounce, hoping the market is going to bounce back up this 30, 35%. I still think there's more upside, but I think it's a sucker's rally because this economy is not going to bounce back that fast. This virus is going to linger. Things are going to be closed way longer than we anticipate, I think. Mm-hmm. And the markets, to me, were ready for a bear market anyway. So that's kind of the big kind of movement there.
And it's interesting because, that's all the talk right now is when is everything going to reopen? Is it going to reopen in May? And then, the Fed's coming in and now they're talking about possibly they could be buying ETFs. But as a technical trader, you're tuning all of that stuff out and just focusing on the charts, just to confirm what I'm
more or less. I listen to it, I see it, I hear it. But I mean, I stopped really following that stuff really closely because I get enough of it from subscribers emailing me. What do you think about this? I mean, they're really my news filter. And I find if I can get rid of the news and get rid of the emotions, and I'm just following price, I don't care what an asset class does. I love precious metals, always have. I own a lot of physical, and I'm expecting a big breakout, and I want a big breakout. But I think it needs more time. Gold had a beautiful break last year and ran. It's in a bull market. Gold miners have been lagging. Juniors are terrible. Silver's been, it's still making lower highs and lower lows. It's still actually in a full-out bear market. It's not even in a basing formation based on the crash last month. Mm-hmm. I think they're going to come back to life, but the next hot pocket in precious metals is the large cap gold stocks.
Now, focusing on silver for 1 second, that's been a point of debate between the silver bugs because, everybody was calling it the bottom in December of 2015. And sure enough, we took out that bottom. So yeah, I don't want to know that we're still in a downtrend and going on to lower lows here, but tell me what you're seeing, what you're looking at mostly on the silver charts. You looking at the monthly, the weekly, the daily, or could you just explore and explain silver and what you're seeing with silver a little bit more for our viewers and listeners?
Sure. Yeah. I look at all the charts, and I think this is one thing where I confuse a lot of my followers actually, is because I can be bullish on one time frame, bearish on another, bullish on another. Just depends on how you zoom in on it, right? So long term, I'm very bullish on silver and gold. I mean, look at the gold silver ratio. I mean, I'm expecting silver is going to base out. When it does break, we're going to see that 2010 type of rally where it just goes ballistic. I think that's coming, but everything takes time, and it always takes way longer than you ever anticipate in the stock market. The market's great for dragging things out. I like silver. I think it's got a lot of work to do to start making some new highs and get up there. But I mean, going forward, it's going to have the best percentage gain. I see gold hitting 2,100 over the next 6 or 12 months. I see it hitting 2,600 maybe over the next 3 years. I mean, those are long-term. Things change on a monthly basis. But you look at silver, I mean, it could go to 40, it could go to 100. I mean, the returns are much better. I did a video this morning that I shared talking about the large cap gold stocks and gold itself and how I'm always looking for the asset that's best right now. And so the gold miner juniors and silver are just, they're not the best right now. They still have huge percentage gains to get to the breakout point, but when they're below that level, they're unsafe to trade. They're very random. They have big volatility right now. If you look at gold, when it broke out last year, we got into gold and it's just been up and bull flag and up. It's just been rallying beautifully. And the large cap gold stocks are testing that level as of this week. If they break out, they will be the gold sector to be in, the large caps. And that's going to spark, I think, a massive rally. We're going to start to see hedge funds and financial advisors moving their people over to these asset classes. And then I think the gold miner juniors and silver will play catch up, and they'll always outperform longer term. But right now, the big pop and the strength, I think, is in the large caps, if it can break.
Now I do want to explore this for a little bit with you. So this question is going to take a second to set up here, Chris.
Sure.
Because this is kind of interesting and this is important because from a trading point of view, I find this very interesting what we're seeing this year because, we see the price of silver, but we've seen this massive disconnect in the physical silver market. Whereas if you own physical silver coins, not only can you, take advantage of the appreciation in price, but also the premium. And we've seen premiums shooting through the roof and silver eagles costing between 25 and $30 at times, even though the price of silver has come down and in a sense come back up some. Here's my point with that. And here's where it ties into the question. Now, if you have physical silver coins in your hand, you could take advantage of that premium and you can gain on the premium in addition to the increase in the price. But if you just have something like SLV, well, there's not really that opportunity for the premium. It's just more in lines with the price. So I think this is where the miners come in, because in addition to the performance of the miners, you have the possible price appreciation of the metal itself. So yeah. I guess the question is, when a person has their bases covered and they have their stack, right? So where can a person look for the opportunities? Because it sounds like to me the opportunities wouldn't be in something that's just as simple like the SLV, but somewhere else where you can not only have the price, but something else with it. Am I making sense at all there, Chris?
Yeah, yeah, you are. I mean, it really comes down to how you perceive precious metals as an asset, right? Everyone's different, and I play a bit of both sides. I like to play metals or the miners like the GDX or GDXJ, or Sprott's got some gold ETFs as well for physical bullion. Everyone sees them differently, and I think you need to play them both. I think you need to own some of the equities, because the equities not only can appreciate, but when the metal appreciates, they also own metals as well. So you're kind of getting the best of both worlds. I've really looked as a big portion of my portfolio as precious metals they're just an insurance plan. And I go against the grain. I don't buy silver eagles. I've never had one. I actually have a subscriber sending me one. It'll be my first silver eagle. He wanted to send me one. But I'm pure bullion rounds and bullion bars, because I think I've bought enough metals that if the financial system collapses, metals should rocket high enough that physical metal will be worth a lot more to counter the loss elsewhere. Mm-hmm. And I think when push comes to shove, I think when metal becomes really expensive, I don't think you're going to get that premium because it's got a stamp on it of some funky design. I think you're going to pay per gram, per ounce type thing. So I'm not into paying that premium. I'm always looking for the best value. And so I'm a rounds and bullion kind of bar guy for long-term insurance. And then I play the gold miners for the speculative kind of pop in our retirement accounts and trading accounts.
Yes, and I was looking at the charts today, and you're right. The GDXJ, it was kind of lagging there. I don't remember the chart specifically, but the GDX, I mean, that thing had a rip-roaring V-shaped recovery already.
Yeah. Yeah.
Bring it back to the fundamentals again. The only thing that concerns me is we look about like mines shutting down or this or that. Is that something that long-term has an effect? Because if I understand this right, there's also times when you're not in the market and when you're sitting out. So as a trader, you don't have to be trading 24/7. There are times when you're not in the market and times when you're in the market. Could you explore a little bit of that with us, Chris?
Oh, for sure. Yeah. So I'm a huge believer of cash. I mean, I'm in cash more than half the time, more than half a year, probably 3/4 of the time of the year. And people don't like it, but they don't. It's just because they don't understand it. So for example, we played gold miners and long equities and long bonds this year. And then as they started to roll over and hit our profit targets, we exited all of them. And we've been sitting in cash and we're sitting at new high water marks. And I'm Canadian. And it's just interesting that the only asset that actually appreciated during that market crash, because we got to sidestep it and watch it unfold without any damage, was the US dollar went up 11% in value. So we moved to cash. To me, that is a position. And our cash value, doesn't matter where you are in the world. I mean, our US dollar cash value actually went up 11% compared to other countries. So people don't see that as a trade, but really we moved to the only place that money was going and everyone was liquidating and they were buying US dollars. And we happened to liquidate before all them and moved in. And so they drove the dollar up. And I mean, we've played it, perfectly to kind of toot my own horn. But going forward, I mean, I think cash is still king. We're 75% cash right now. We're long the equities on this bounce. I'm starting to get excited about the large cap gold miners. If they break out here, I mean, I think you got to take a position because it's the start of a bull market. Could be huge. So cash is king. You can't go wrong. I mean, I know a lot of people wanted to profit from the big drop, which we did. We profited 20% in bonds, but we really watched the last month of that volatility sitting in our armchair. And the feedback was amazing because everyone's like, wow, it is so amazing to watch this. And our account is like, trading at all-time highs. And we're now just sitting back looking for the best asset now. And volatility has been so high, I haven't found the best asset other than we got long the SP 500 a little while ago, took some profits off at our first fib target yesterday. So now who knows where the markets are going? They could roll over here. But now we're sitting back waiting for the next best asset to perform for us.
Mm-hmm. And speaking of the dollar, the DXY has had some major, massive swings as well.
It has.
What do you look at when you look at the dollar? Are you just looking at currency pairs? Are you looking at an index in general? Or what are your thoughts of the currencies in general?
I don't follow the currencies too much. I go to FinViz because I don't pay for the data feed for the DXY because it's a ridiculous price for one symbol that I want to look at. So I look at FinViz, which I think it's the DXY, I think, and the UUP ETF, which mimics the US dollar. Now, they don't both move the exact same, but they're similar. All I want to know is what the trend is and if the dollar is going higher or lower that day, because I watch it really just to see how the precious metals perform in relation to it. And really the safe haven play over the last year has been the US dollar and precious metals. I mean, there's been a big sell-off in them, but I mean, steadily the dollar keeps climbing, metals are holding up and testing highs. I mean, they are the safe haven still.
And, I recall very distinctly in mid 2014 when the dollar index went on that tear. So it was basically about 6 months when it went up to 100. But are you like a dollar index going to 120 guy, or are you a dollar's going to crash guy, or you're just looking at the charts and getting your clues off of the charts with all of the extra fundamental noise out of it?
I mean, the chart is still bullish. I'd love to see $1.20. I mean, the trend is up. It's still going up. So, I mean, I like a higher dollar. I think a higher dollar is better in general for me personally. Anyway, so yeah, that's what I think. I think the dollar is going to continue to go when it does roll over and start to crater, which could be, maybe we go into a bear market here with equities. We have this what do you call it? Suckers rally that rolls over, sells off. And then we go into a bear market, a full out bear market, and the US dollar continues to rise. I think we could reach that 120. But when the stock market starts to put in a bottom, I think it's going to do what it did in 08, 09, where the dollar just starts to tank and sell off. And that's when precious metals, I think, are really going to explode. I mean, a lot of people are expecting metals to go higher now and continue. I think the real fireworks is going to be after this bear market in equities, because the bear market is going to suck the commodities and the equities down, the gold equities with them, just like it did in the last crash. I don't know if it'll suck it down all the way, but I think they'll struggle to move higher. I think this time around, there's definitely going to be more money moving into metals than there were in 2009, because now people see there's serious financial problems. Like, I mean, they got their own printing machine at zero interest rates. I mean, it's total BS, right? Metals should go through the roof. So I think metals will hold up fairly well. I don't think they're going to rally huge like people think until the stock market bottoms. and then people are going to like dump the dollar's going to collapse, and we're going to see metals go ballistic as the ultimate safe haven when investors give up on stocks finally, which is always at the bottom of a bear market, and they're going to look for the best asset then, and that'll be precious metals, and we'll see that big multi-year rally.
And it could take several months for the stock market to bottom, or even looking for something longer term than that before we find the actual bottom in the stock market.
I think it's 6, 10 months. I think it's still a long ways away,
Hmm.
but I mean, it's not a bad thing as long as you understand what's happening. I mean, you can profit from both sides, and I think the metals are going to hold fairly well
Hmm.
because everyone sees this time around that there is serious financial problems. They're just giving money out to everyone, literally.
Hmm. And then also a follow up on that question is, could you explain just a little bit more? Why is it that the gold miners or the miners would be going down when the stock market's going down? Isn't that supposed to be an inverse relationship or something? Or could you explain that a little bit, Chris?
Sure. Yeah, they follow each other quite a bit. I mean, when the stock market goes down, think of it as like the ocean and the tide. And when the tide goes down, pretty much all boats go down. I mean, there's the odd one hanging on ropes from the dock. And so gold miners will typically outperform. This is the time they should start to outperform, actually. So this breakout in GDX, I think, is got some legs behind it. And what we've seen in the past is the end of a bull market in equities, the start of a bear market, which is right where we are now, dead center, is when we see gold miners start to rally and start to outperform the stock market in general, which they are right now. And they've had a huge rally. And I think the stock market's going to become choppy. We're at a Fibonacci resistance level. I think there's 5 or 10 more% to the upside. But I think gold miners are just going to break out and continue to expand and go higher. I think that could last a few weeks, several months, but eventually they're going to get pulled down a bit when the tide sells off, the equities market pulls down. But I think they're going to be a great opportunity going forward here.
And I do know that you also follow the energy sector very closely, but I guess using the acronym BAN, is it BAN? Is that the acronym
Yeah,
BAN?
yeah.
Using the acronym BAN, I guess you don't want to be anywhere near the energy sector right now until it finds a bottom. Or I mean, I guess is crude oil going to $8 a barrel, or what's going on in the energy sector right now, Chris?
I know it's under pressure. I mean, the trend is down. You could play an inverse ETF that'll rise as it keeps falling. Crude oil is testing support today, really critical, that $19-20 level. If it breaks that, the next level is 17 and then 14. And that's where, if you look at the big monthly charts and put a bunch of analysis together, 14 to 17 is that window that would be a major significant bottom. I don't think it'll really go much lower than that. But I mean, I don't pick bottoms. And that's the one thing. I don't pick tops. I don't pick bottoms. I let the market decide. And I always have a trailing stop. And when it rolls over, I'll get out that way. So I'm always late getting out, always a little early or late getting in as well. It's all about catching that middle chunk, that trending part. You get in at the beginning. As it rolls over, you get out as it's starting to roll. So I think the energy sector is got lots of downside potential, but it's plagued with headline news. And that's the big thing. Like there was rumor of the OPEC meeting with Russia and the Saudis, and in 3 days it rallied 50%.
Mm-hmm.
And that was on news. And then the news got delayed and it crashed 10%. And then there was crappy results and it fell all the way back down to that 19 level. So at any point, if you put a trade on in the energy sector, you're at risk of some piece of news coming out from Trump or anywhere, OPEC, and you're toast. If you're on the wrong side, you're going to lose a chunk of your account. As much as I'd love to catch these big moves, you're gambling with random headlines like that.
That's a question I wanted to ask you about because I've asked other technical traders this, and I find it very interesting because just I think 2 days ago, or was it Monday, President Trump actually sent out a tweet saying, no, it wasn't really talking about a 10 million barrel cut. We were talking about a 20 million barrel cut. So as a technical trader, how do you look at President Trump's Twitter feed? Because I mean, to me, it would have to move markets. I don't know how there's not HFT algos that aren't feeding off of Twitter
Yeah.
feeds. So how do you incorporate those tweets into your trading, or do you just not incorporate them in at all?
Yeah, I've never even looked at his tweet. I hear about them instantly from everyone, right? But and that's all I need because they're random. You never know when he's going to post, and that's why I'm not a fan of news or trading off fundamentals, is because you just never know what kind of data is coming. You can predict they're going to have good earnings and they don't. I mean, to me, news is the ultimate. I mean, it's a 50-50 bet. And even if you got the bet right, you never know how the general public's going to react because it usually does the opposite of what the news is, right? Unless you understand the buy the rumor, sell on news type of thing. It's really tough to trade even economic data that is really somewhat predictable. You never know how people are going to actually perceive it on the end, right? So I don't follow the tweets and stuff. They usually affect the market and cause whatever we're in to have an intraday blip here and there. But anything based on news is usually a blip on the chart, and the underlying trend, which is what we're following, usually picks up the slack and regains its strength and does its thing. And usually we're okay because I'm always following the tide. It's going up in general. So there's the odd hiccup, but that's about it.
It sounds like what I'm hearing is like, for me being a fundamentalist, it would be more of a long-term type of investment where you can be right on the fundamentals. But if you're actually wanting to trade this, you have to pay attention to these charts because these charts matter. That's what I'm understanding there. And then just one more question. It also sounds like, you're not trying to make 10 baggers on every trade you put on, right? You're not trying to buy some call options and make, 100 times or 1,000 times your money. You're just looking to make a little bit and pull it out and then reassess and see what next sector is coming hot. Is that how I'm seeing how a successful trading plan or strategy can come about? Is that what I'm getting here, Chris?
Yeah, exactly. I mean, I go against the grain for a lot of traders and the followers that I have and subscribers. They appreciate what I do, which is we're not looking for big moves. And I make trading actually really boring because every day I explain what happened yesterday, what happened in overnight trading, and what should happen today with our positions in the markets and what's out of whack and what should pull back and what should bounce. And I go through all the technicals each day. And because we know what's going on and we walked through the market collapse together, we've watched it put in a bottom, we're watching patterns set up. It's actually pretty boring because we see it unfolding days ahead of a time. And so when we get into a trade, because I'm looking for stuff that is highly liquid and very reliable and has low volatility, I'm only looking for that 3-5% return on a trade. But we're trading assets that we can put in 25%, 50%, even 75% of our portfolio. So when we have a trade that moves 3 or 5% on 75% of our account on the SP 500, our whole account just went up, 2.5-3% in general versus trading 10 or 12 stocks that are moving 20% but they're small positions and you're yo-yoing all these trades. I mean, I think Jack Schwager, his Market Wizards books, every book, there's always a guy in there saying, you don't need 40 positions. You don't need 20 positions. You don't need 12 positions. They came down to 7 positions is enough to have diversification. You're not overloaded. You're not doubling up on stuff. And you can play that stuff. And I don't even do that many. I really just focus on high alpha. So we're long the SP 500 or assets that are moving, and then we're cash. And then we'll be in bonds when things look ugly in the markets, and then we go back to cash. So we're just constantly just juggling these kind of big, comfortable assets that big money can move in and out of easily.
And if a trade would go against you, you just get out of that right away with your stop.
Yeah, we've got tight stops, usually around 3%. So, I mean, it's pretty straightforward. I mean, it doesn't sound exciting. And I tell subscribers all the time, I'm like, if trading's boring, it means you're doing it well because you're not riding that roller coaster. You're not hit by surprise. You're not playing crazy volatile stuff. And all we need to do is make 2% return on our portfolio a month, which is 1 or 2 ETF trades. And that's 24% return on a year. If we do better than that, 3-4% a month, I mean, you're looking at a 50% return. It sounds really boring and slow, but when you crunch the numbers, I mean, it's tough to beat returns. And we've been doing that for the last 2 years, about 48% each year. And I mean, this year it's been a little slower, but just because we've been in cash during this crash, but things are starting to stabilize again. New positions are getting put in place, and we're going to get back into trading again.
Mm-hmm. And, I was going to do this as the last question, but I'll do it as a second to last since we're on it. But what exactly does a subscriber get? They get trading alerts, but they also get a satisfaction guarantee, if I understand that right, or a performance guarantee, or what all can a person get when they subscribe to the Technical Traders?
Right. So there's actually two newsletters. So I've got the Technical Investor, which is on the same website. And it's for long-term investors. If you pretty much have any retirement account, it tells you when you should have your assets, whether you trade them yourself or they're with your financial advisor, when to be in equities, and then when to be either in cash or own an inverse ETF. And I mean, just sidestepping a bear market alone, your alpha, your percentage gains long term are just ridiculous because you're not riding it down and taking years to get back to break even. So that is kind of my, the kind of newsletter that really everyone should have, because everyone has money saved up. Your retirement account is our biggest asset class other than our house that we own. So you've got to protect it. And then I've got the Technical Trader newsletter, which is more active. Every morning I give you a video that's 8 to 15 minutes long. I recap everything that's going on in the markets, what to expect, how it's going to affect our positions. And so you get to watch that before the opening bell. So you go into the day really comfortable. And even if it's a really big emotional day, I mean, I talk about it all the time, is everyone's going to be emotional today. The VIX is up. This is a huge gap, but you can be really comfortable knowing this is normal. This is where it should go. It's going to continue like this. And so there's comfort in knowing what's going on. And then, of course, I give them my trade alerts whenever we have a new ETF trade. They can go and they can follow that. And I give all the details from our entry price to our first target, second target. We've got a trailing kind of profit target. So we'll let something keep running because you never know how far something's going to run. And our stop loss, obviously, which gets adjusted over time. So yeah, that's the core of it.
And if you're letting something run, you would take some of that off and let some more keep running. So you're with the house money at that point.
Exactly. Like the SP 500 hit our first target yesterday. We pulled off 25% of our position. We moved our stop up to break even. So now we're covered. And hopefully we're going to run up, hit the next target. We'll pull off another quarter. Actually, the next one, we'll pull off 50% of our position on it. And then we let that last quarter just continue to run, because beyond a certain level, the SP 500 struggles to actually continue higher. It'll typically want to roll over. So there's certain statistical analysis I use in a lot of assets. I know what the average points are where they're going to turn. I match it with Fibonacci targets, and I'll take the lowest of the two, because the markets will always roll over and take their first pullback at their first opportunity of resistance. So I want to make sure I always take a target at the lowest target I can find, which sounds silly, but I mean, once it hits that target, a lot of times the market crashes or the asset falls after that and never comes back. So we make a little bit, get the rest out at break even, and we look for the next one. And if you don't do that, man, you can get slaughtered.
Yeah, and I can attest to that too with your writing, with what I see, because, some analysts will write and, they're just targeting something on a downside, or they're targeting something from the upside. And then you send over your work for us to publish. And I mean, you got it going both ways. You're like, okay, it's going to break out to here and then it's going to fall down to here. And I'm like, oh my goodness, that's the kind of analysis that you want to see, because it's talking about those pivots there, I guess.
Well, yeah. And that's one thing I think that gets people confused as well, is we say it's going, up and down, and people are like, well, you can't call both sides. I'm like, well, we can, because it doesn't matter which way it's going to go. We just have to trade the move in that direction. And when it starts to make that move, we analyze it. Is that the best asset right now? Is there headline risk? Is there other risk that's added in there that we now want to avoid it? So we see a lot of these great setups. We don't take them because there's just way too much risk, with the stock market still moving 5 to 10% a day. Gold miners ETF is moving, 25% a day some of these days. I mean, I love it. It's awesome, but I don't want to risk everyone's money trying to make a quick buck, because if you're against it one day by mistake, I mean, you're toast. I'd rather take a 3% loss than a 15 or 25 when you have no control, because some of these gaps the next day, you don't have a chance to get out. You just get slaughtered, right?
Mm-hmm. So discipline, boring discipline is what you want.
Yeah.
Now, Chris, in closing thoughts here today, everybody's looking at May 1st for one reason. That's either the date we reopen, or that's the reason that, the world is magically cured. Or what is on your radar as we go through the second half of April? Is May 1st on your mind for something, or what are you looking at? Are you looking at something specific with the economy, something specific with the human malware that's going around the world, or what is on your radar the most right now for the next couple of weeks, Chris?
Yeah. So the whole idea of them lifting the ban of everyone moving around and doing stuff really scares me. I don't know what I don't think they should, because what's going to happen? Everybody's going to go back out. There's going to be another flare up. Things are going to spike again. They're going to shut it down again if they do that. I think it's way too early. I think this needs to drag out a lot longer, which isn't good for businesses and the economy. But I mean, if they do it too early, there's just going to be another flare up. Viruses start to spread and spike in towns. And so I'm worried about that. And then we've always got the sell in May and go away. I mean, things could just happen to fall perfectly in line that the stock market's got this sucker rally. We play this to the upside. It starts to roll over. We get our next trade and we get that sell in May. We get a flare up on the virus. We see the market do a double dip, potentially break those lows and keep on going. So there's a lot of opportunity, I think, in May on this. As much as I hate the economy falling apart and lower prices, I mean, it's going with or without you, so you might as well profit from it. You just got to be aware that whatever it does, you just have to be in position for it and make sure you don't hold on. When something's going against you, you got to get out because this market won't give you a chance to get out at a good price for very long.
These are interesting times and these are exciting times and these are going to be spectacular times in these markets. Yeah. Chris Vermeulen, I'd like to thank you for joining us today on Silver Doctors.
Thanks for having me, Paul.